Ladies and gentlemen, pause for a moment and ask yourself this powerful question. What if the world you rely on for stability, growth, and opportunity just changed overnight? Today's title is not just a headline, it is a wake-up call. It has begun. Japan just pulled the plug on the global economy. These words are bold, unsettling, and impossible to ignore. They signal a turning point not only for markets and nations, but for mindsets, leadership, and the future we are preparing for right now. So as we reflect on this powerful moment, it has begun. Let us not respond with fear, but with focus. Not with doubt, but with determination. The world is changing, yes, but change has always been the birthplace of progress. Stand tall, think forward, and move with purpose. Because when the global economy resets, those who rise are the ones who choose action over anxiety, and that choice starts now. Japan's latest move represents far more than a routine policy adjustment. It signals a decisive shift in how one of the world's most influential economies views its role in a rapidly changing global system. For decades, Japan has been a stabilizing force, known for ultra-loose monetary policies, massive bond purchases, and a commitment to supporting both domestic growth and global liquidity. When a nation with this level of economic weight changes course, the message is unmistakable. The old balance is no longer sustainable. This is the kind of moment that quietly reshapes the future, while the world is still trying to understand the present. What makes this shift so powerful is not just the policy itself, but the timing. Global markets are already navigating inflationary pressure, geopolitical uncertainty, and fragile supply chains. Japan, stepping back from its long-standing economic posture, introduces a new layer of uncertainty, one that investors, governments, and institutions cannot afford to ignore. The hook lies here. When the most patient economy in the world decides it can no longer wait, it tells us something fundamental has changed beneath the surface of the global system. Japan's influence stretches deep into international finance. It is one of the largest holders of foreign assets, a key player in currency markets, and a critical engine of global trade. Any recalibration in its strategy sends immediate ripples through exchange rates, bond yields, and capital flows. This is not speculation. It is cause and effect. Markets do not react because they are emotional, they react because they recognize power when it moves. And Japan has just moved, yet beneath the technical language of economics lies a more human story. Discipline meeting reality. Japan has endured decades of slow growth, deflation, and demographic challenges, all while supporting global stability. This shift suggests a hard truth. No economy, no matter how resilient, can indefinitely carry the weight of global imbalance. The unspoken hook is this: if Japan is protecting its future now, who else will be forced to do the same next? This moment demands attention because it challenges assumptions. It reminds the world that economic leadership is not static, and that stability is not guaranteed by tradition alone. Japan's signal is not one of panic, but of preparation. It reflects a calculated decision to adapt before being forced to react, and in a global economy built on confidence, perception can be just as powerful as policy. The world is watching, markets are listening, and the implications are only beginning to unfold. The global market reaction to Japan's recent move has been swift, measured, and deeply revealing. Financial markets are often described as forward-looking, and in this case, they are not waiting for certainty, they are pricing in possibility. Stock indices, currency markets, and bond yields have all shown signs of recalibration. Reflecting a collective pause among investors worldwide, the hook is unmistakable. When markets hesitate in unison, it is rarely about fear alone. It is about recalculating the future. Japan's role in global finance makes this reaction unavoidable. As one of the largest creditors in the world, even subtle shifts in its economic stance can influence capital flows across continents. Investors are now reassessing risk exposure, particularly in regions and sectors heavily tied to Japanese investment and trade. Currency markets have responded with heightened volatility, signaling uncertainty not just about Japan's direction, but about how other major economies might follow. Markets are not asking if change is coming. They are asking how fast and how far it will go. What intensifies this uncertainty is the fragile state of the global economic environment. Inflation remains persistent in many economies. Central banks are balancing growth with tightening policies, and geopolitical tensions continue to disrupt trade routes and energy supplies. Against this backdrop, Japan's shift acts like a pressure test on an already strained system. The hook lies here. When one of the world's most cautious economic players makes a decisive move, markets assume it knows something others may soon have to face. Investor behavior tells a powerful story. There is a visible rotation toward safer assets, increased demand for liquidity, and a growing preference for flexibility over long-term commitments. This does not signal collapse, it signals caution. Markets are not fleeing, they are repositioning. Volatility, in this sense, becomes a language of adaptation, not panic. Every fluctuation reflects an attempt to find a new equilibrium in a world where old assumptions no longer feel secure. Perhaps the most telling response is psychological confidence. The invisible currency of markets has been shaken, not broken, but tested. Traders and institutions are no longer reacting to isolated data points. They are responding to signals of systemic change. The unspoken hook is this: uncertainty is no longer the exception. It is becoming the baseline. And in such an environment, those who understand risk, timing, and resilience will define the next phase of global economic leadership. But the growing belief that the era of traditional economic policies is coming to an end is no longer confined to academic debate or policy circles. It is now being reflected in real-world decisions by major economies. For decades, the global system has relied on familiar tools, ultra-low interest rates, aggressive monetary easing, and large-scale government intervention to manage crises and stimulate growth. These measures once acted as lifelines, but their effectiveness has gradually diminished. The hook is impossible to ignore when the tools designed to save the system start losing their power. The system itself demands reinvention. Japan's shift highlights a broader realization that prolonged reliance on extraordinary measures carries long-term consequences. Years of easy money helped stabilize markets, but they also distorted asset prices, encouraged excessive risk-taking, and weakened the natural signals that guide economic decision-making. Inflationary pressures, growing public debt, and declining productivity are no longer side effects. They are warnings. This moment signals that policymakers can no longer rely on the same playbook and expect different results. What makes this transition particularly significant is the global consensus quietly forming around it. Central banks across the world are grappling with the same dilemma: tighten too quickly and risk recession, or maintain support and risk long-term instability. Japan's move acts as a reference point, suggesting that the cost of maintaining outdated policies may now outweigh the risks of change. The hook lies here. Abandoning familiar strategies is uncomfortable, but clinging to them may be far more dangerous. This shift also exposes a deeper transformation in economic philosophy. Growth is no longer being viewed solely through the lens of stimulus and expansion, but through sustainability, resilience, and structural reform. Governments are being forced to confront issues that monetary policy alone cannot fix. Aging populations, workforce productivity, supply chain fragility, and technological disruption. The old assumption that central banks can solve every problem is fading, and with it, a sense of artificial security. Markets are responding not just to policy changes, but to the acknowledgement of limits. This recognition reshapes expectations, redefining how risk is priced and how value is measured. The unspoken hook is this: the end of an era does not mean failure, it means evolution. Economic systems, like societies, must adapt or fall behind. What we are witnessing is not the collapse of policy, but the moment it is being challenged to become smarter, more disciplined, and more aligned with reality. Japan's decision has sent a clear and unsettling signal to the world about the hidden risks of global dependence. For years, nations and industries have built growth strategies on interconnected supply chains, shared financial systems, and the assumption that major economies would always provide stability. This model delivered efficiency and scale, but it also created vulnerability. The hook emerges here. When one cornerstone of the global system adjusts its priorities, every structure leaning on it begins to feel the strain. The reality is that excessive dependence dulls preparedness. Many countries relied on Japan not just as a trading partner, but as a source of capital, technology, and financial reassurance. When that reliability appears less guaranteed, governments and institutions are forced to confront an uncomfortable truth: outsourcing stability comes at a cost. Japan's shift highlights the need for economic self-awareness, where nations reassess how exposed they are to decisions beyond their control. This moment reframes the conversation around resilience. Economic strength is no longer defined solely by global reach, but by the ability to withstand disruption independently. The hook lies in this realization. True security is not built on access alone, but on capability. Countries are now being pushed to diversify supply chains, strengthen domestic industries, and reduce over-reliance on external capital flows. These adjustments are not acts of retreat, they are acts of preparation. The warning extends beyond governments to corporations and financial institutions. Businesses that once optimized solely for cost efficiency must now account for geopolitical risk, currency volatility, and policy shifts in key partner nations. Japan's move exposes how fragile hyper-efficiency can be when flexibility is sacrificed. The unspoken hook is this: the cheapest system is often the most expensive when conditions change. At its core, this signe challenges long-standing assumptions about globalization. Interdependence is not disappearing, but it is being redefined. Cooperation without resilience creates imbalance, and imbalance eventually demands correction. Japan's actions remind the global community that economic sovereignty matters, not as isolation, but as balance. As nations absorb this message, the world may begin to see a shift from blind reliance to strategic partnership, where strength is measured not just by who you depend on, but by how well you can stand when that support is tested. The ripple effects of Japan's economic shift are already being felt far beyond its borders, touching industries, trade routes, and financial systems across the globe. In an interconnected world, no major policy change remains isolated, especially when it comes from an economy as deeply embedded in global supply chains as Japan. The hook becomes clear almost immediately. When one major gear in the global machine slows or changes direction, the entire system must recalibrate. Trade is among the first areas to feel the impact. Japan plays a critical role in exporting advanced machinery, automobiles, electronics, and industrial components that form the backbone of manufacturing worldwide. Even minor disruptions or strategic realignments can delay production timelines, raise costs, and force companies to seek alternative suppliers. These adjustments take time, and time in global markets translates directly into uncertainty. The unspoken hook here is that supply chains are only as strong as their most irreplaceable link, and Japan has long been one of them. Financial markets are experiencing similar reverberations. Japanese capital flows support everything from government bonds in developed economies to infrastructure projects in emerging markets. A shift in investment priorities can tighten liquidity, increase borrowing costs, and pressure currencies, particularly in regions heavily dependent on foreign capital. This is not a theoretical risk. It is a practical challenge that governments and institutions must now factor into their planning. The impact extends to energy, technology, and consumer markets as well. Japan's strategic decisions influence demand forecasts, research partnerships, and pricing structures across multiple sectors. Companies reliant on Japanese innovation or joint ventures may face recalibration in funding and long-term strategy. The hook lies in this reality. Global industries have grown accustomed to predictability, and predictability is now being questioned. Perhaps the most significant ripple is psychological confidence shapes investment decisions, and confidence thrives on clarity. When uncertainty spreads, even healthy systems slow as stakeholders wait for signals of direction. This hesitation can amplify the economic impact far beyond the original policy change. The unspoken hook is that perception can move markets as powerfully as action. These ripple effects serve as a reminder that globalization amplifies both strength and vulnerability. The benefits of interconnected growth are undeniable, but so are the risks when one major player adjusts its course. As these waves continue to spread, economies and industries worldwide are being forced to reassess exposure, adaptability, and long-term resilience in a world where no decision exists in isolation. But what many initially interpret as a looming crisis is increasingly being viewed by experts as a pivotal turning point in the global economic narrative. Moments like this have appeared throughout history, often disguised as disruption, only to later be recognized as the beginning of a new phase of growth and realignment. The hook is subtle but powerful. Every major economic transformation first feels like instability before it reveals its opportunity. Japan's move has accelerated conversations about reform, innovation, and long-term sustainability across the world. Policymakers are no longer focused solely on short-term market reactions. They are being pushed to address structural weaknesses that have been postponed for years. Issues such as over-leveraged systems, aging infrastructure, productivity stagnation, and technological gaps are moving from the background to the center of strategic planning. This moment forces decision-makers to ask not how to preserve the past, but how to build something stronger for the future. Innovation often thrives under pressure, and this shift may act as a catalyst for exactly that. New financial models, diversified trade partnerships, and smarter investment strategies are already being explored as alternatives to outdated frameworks. The hook lies here. When the safety net feels thinner, creativity becomes sharper. Economies that embrace flexibility, digital transformation, and forward-looking policies may find themselves emerging more competitive than before. This turning point also reshapes leadership dynamics on the global stage. Economic influence is no longer determined solely by size, but by adaptability and vision. Countries willing to reform labor markets, invest in technology, and balance growth with resilience may set new standards for success. Japan's signal highlights that leadership today is less about maintaining dominance and more about navigating change with discipline and foresight. At a deeper level, this reset challenges the psychology of markets and societies. It encourages a shift away from dependency and toward accountability, away from short-term comfort and toward long-term stability. The unspoken hook is this: moments of uncertainty redefine priorities. They expose inefficiencies, reward preparation, and separate reactive systems from resilient ones.